Welcome to Support and Resistance Part 2, presented by Daily FX Education. In the first video, we taught you the basics of support and resistance, and how to identify some trading opportunities using this concept. In this video, we'll go into much more detail on support and resistance. We'll cover more scenarios on determining support and resistance, and how you can trade with them. Much like a 4-story apartment complex provides a floor and ceiling for its tenants, support and resistance in trading will act the same way. Traders will identify these areas on a chart and plan trade entries to buy or go long at support and sell or short at resistance. For example, a tenant on the 3rd level is supported by the ceiling on the 2nd level. So if the tenant on the 3rd level were to fall to the 2nd floor, what was his floor has now become his ceiling. Sometimes support and resistance can be obvious. There are other times where levels are hidden and are not obvious to the naked eye. Let's start off with some more obvious levels. Oftentimes, sideways trading ranges create areas of congestion on the chart. Much like when you're driving rush hour traffic, the traffic congestion makes you slow down and may cause you to be late for an appointment. Or as a result of the traffic congestion, you may decide to turn around and take a different road. The analogy is similar to price congestion on a chart. When prices seem to lack direction and hang out at the same price levels, it creates congestion. Over time, that congestion creates a level of support and resistance. Eventually, prices will leave the area. However, when prices return to the same area, at a minimum, it slows down the trend or even causes the prices to bounce and move in the opposite direction. The more time that price spends in a certain area, the more vested interest that exists at that particular price. Think of two groups of traders, those that went long and those that went short. The longs and shorts initiated their trades at the same price. As the price increases, the longs are making money, and the shorts are obviously not. If price comes back to the original level, then the longs will likely protect their position by buying more, and the shorts, thankful to get out at break-even, will likely cover their positions, adding to the pool of buyers. The vested interest creates buying pressure, and the former period of congestion becomes support. This dynamic happens frequently, but it's often overlooked by traders focused solely on technical indicators rather than pure price action. This charts the daily price bar on the euro-pound. The first arrow to the left shows where prices began to create a congestion zone. When the prices returned 45 days later, they were caught in the congestion area, which acted like support, and the prices reversed back to the upside. On the 3rd occasion of entering congestion area, prices slowed down, then eventually worked themselves through to the other side. We don't know if the prices will simply slow down or reverse, so when entering positions, it's always good to note congestion areas as zones to consider taking profits at. In this instance, a trader who went short in March of 2009 would likely look to take at least partial profits when the price enters the congestion zone in April. Yet another method of using static values as support and resistance is based on the previous day's high and low. The highest value the price traded at for the previous day is often a difficult barrier to overcome and can act as resistance. A trader would look for prices to approach yesterday's high, look for a bearish candle formation or an oscillator rolling over, then sell short. Since the Forex market is traded 24 hours a day, traders typically use the daily bar that begins and ends at 5 p.m. Eastern Time, or New York time. Here's an example from the dollar-yen in early June of 2009. The thick red lines are the previous day's high prices. Notice how in the first circle, prices came close but did not quite reach the line. This can show you how much respect the prices give to these daily highs. The second circle shows a candle that pierced the daily high, then retreated back inside the range, leaving a long wick behind. This is a bearish shooting star candle formation. In the third circle, prices are leaving long wicks to the upside as the prices approach the previous day's high. When looking for a trading opportunity, identify the direction of the daily trend. If the daily trend is down, identify the previous day's high. As the price approaches this level, look for a bearish candlestick pattern to form, then consider placing a short trade. You would enter your stop just above the swing high, which should be above the resistance area you identified. Likewise, the lowest value the price traded at for the previous day is often a support level to buy at. A trader would look for prices to approach yesterday's low, then look for a bullish candle formation or an oscillator crossing up, then go long or buy. The first circle to the left shows where the price pierced the support line but returned back above. Then a couple hours later, it retested those same lows. That's a good bullish signal for a trader to buy near the green line. The second circle shows where the prices did not quite make it to the green line, which indicates the lack of downward momentum and the barrier provided by the previous day's low. The third circle shows where the line pierced the previous day's low 2 hours in a row, yet the hourly candle still closed above the green line. It later retested for a third time. The long wicks on the first two tests were good clues of the market's respect for the previous day's low. Below is another example from June of 2009, this time on the pound dollar. In these instances, I like to see the candle pierce my support line, then wait for it to close back above support. If a long wick is left behind to the downside, like in the third example, then I'll look to enter a half to 2/3 the way down the wick. I'd place a stop 25 pips or so below the low of the long wick. One final point for using the previous day's high and low values. Both of the examples were taken from June of 2009. If you remember, June was a very ranging month. These support and resistance levels tend to hold up nicely during quiet ranging times like June. As prices go into a trend, sometimes a future stopping point could be as simple as a round number. When thinking of the bigger picture, traders will look to round numbers as being too expensive or very cheap for something. After all, if a friend has some tickets to sell to a basketball game, and you want to buy them, do you offer $94.75 for the tickets or an even 100? Round numbers are the reason as to why retail stores offer merchandise and groceries for pennies less than a round dollar figure. For example, a gallon of milk appears cheaper at $1.95 per gallon than does $2 or $2.01. The difference in money spent is very little, but the perception can be large enough to cause traders to pause and close out open positions, or take new positions in the opposite direction. Here's another chart of the dollar Swiss from 2000 to 2008. The price dropped 45% from 1.8 to near 1.0. At that point, traders who were short wanted to take profits. Also, as the price temporarily dipped below 1.0, the dollar Swiss looked cheap, so buyers rushed in. Also, on this chart of the dollar Swiss, notice how prices were resisted twice to start the downward trend at 1.8. There's a psychological power of round numbers that should not be ignored. There are several indicators that traders like to add to their charts to help determine levels of support and resistance. A common indicator that most every trader uses is a moving average. Moving averages are multifaceted, and one of those uses is to act like support and resistance. For example, if you add a 20-period simple moving average to a chart, many traders will look to that moving average as resistance if the current price is below the moving average, or as support if the current price is above the moving average. As the price approaches the moving average from below, look for a bearish candle formation, or for an oscillator to cross down, then enter the trade. Common lengths of moving averages to act as support and resistance are 20-period, 50-period, and 200-period moving averages. Here's an example of the dollar-yen from 2008, where the 20-period simple moving average offered strong resistance and provided many opportunities to go short. Using the same type of situation, but in a bullish scenario, with the simple moving average as support, the price of the Aussie yen increased above the 50-period simple moving average. After prices began to trend upward, the trend found support at the 50-period simple moving average for the next several months. To enter a bullish trade, wait for the price to pierce the moving average, then enter long when the candle closes above the moving average. Place your stop approximately 25 pips below the swing low. To learn more about moving averages and how to use them, please refer to the Moving Averages series within this course. Another common indicator you can add to the chart for support and resistance are the Bollinger Bands. Just like the moving average, Bollinger Bands have several uses, one of which is support and resistance. In a range-bound market, prices are anticipated to revert back to the mean, or the average. The Bollinger Bands surrounds the moving average with bands, typically 2 standard deviations away. In mathematics, 95% of the prices are contained within 2 standard deviations of the moving average. When the prices reach towards an upper Bollinger Band, the upper band can act like resistance and push the prices back towards the middle. Conversely, when prices reach towards the lower band, prices will balance and move back towards the moving average upward. Here's an example of the Swiss yen in the summer of 2009. The Bollinger Bands are fairly horizontal, indicating a range-bound market. The Bollinger Bands act like support and resistance for several months. Since the daily trend is up, a trader would wait for the price to reach the lower band, which would act as support. Wait for the price to pierce the lower band and close above it. Then enter the long trade with your stop just below the swing low. For more uses on how to use the Bollinger Bands as support and resistance, refer to the Bollinger Band series within this course. In the example shown towards the beginning of this video, the floor, or support, and the ceiling, or resistance, are constant values. Many times, values of financial assets will trend up or down. This makes these barriers change price over time. If the asset is trending up, occasionally profit-taking will occur and values will plateau and eventually pull back. Traders watch the value of the asset as it approaches an upward sloping trend line which is acting like support. A less common way to trade support and resistance is through trend lines drawn on oscillators. Many times oscillators will rise and fall, showing areas of support and resistance. These are areas on the chart where prices may find hidden support or resistance. These areas are considered hidden because they're not as obvious to a trader as horizontal support, resistance, trend lines, and round numbers. To create the trend line on an oscillator, you find common points where the oscillator did not drop below as support. Here's an example of the euro-dollar spanning over a 12-month period from September of 2008 to August of 2009. The RSI was continually met with support by a rising trend line. When the RSI nears the support line, a trader could look to place a long trade, confirmed through a bullish candle formation, or touch of a support line in the price chart. Another way to trade the trend line on oscillators is to look for a trend line break. Since the RSI oscillator is bound by 0 and 100, eventually the trend line will break as the RSI values get squeezed upward. As the trend line squeezes the RSI up, a break below the trend line can offer an opportunity to short the pair. If you trade a trend line break on an oscillator, make sure you're looking for trades in the direction of the daily trend. A similar method can be applied to the stochastics oscillator as well. Notice here on the pound dollar that the trend line on the stochastics breaks before the trend line on the chart. This is an early clue to the weakness ahead of this pair. After a break of the stochastics trend line, what was former support now becomes new resistance. A backside test of the stochastics trend line coincides with a simultaneous break of the trend line of the prices on the chart. Entering a trade on the trend line break was risky since the pair was in an uptrend. However, the stochastics trend line break and the support line break of prices indicates potential weakness ahead. Since a trend change requires us to see a series of lower highs and lower lows, the lower high came when prices tested the backside of the price support line. Once prices break to a lower low or break below horizontal support, then confidence in the trend change builds. At this point, a trader could look for horizontal support to break and place a breakout trade going short. Drawing trend lines on oscillators can be applied to most of the oscillators you're familiar with, including the MACD and CCI. The concepts of support and resistance on the oscillators work similar to the examples of the RSI and stochastics noted previously. Simply use your favorite oscillator on the chart and look for areas of support and resistance. I personally look for breaks of these trend lines in the direction of the daily trend, as they can produce some sharp moves. We've uncovered some hidden support and resistance through oscillators on the chart. There are also hidden areas in the price area of the chart. The good news is that most of these additional hidden areas of support and resistance can be made visible through tools available through most charting packages. The first set of hidden support resistance are Fibonacci retracement levels. The second set of support and resistance levels are pivot points. Leonardo Fibonacci was a famous Italian mathematician born in the 12th century. He's known to have discovered the Fibonacci numbers, which are a sequence of numbers where each successive number is the sum of the two previous numbers. For example, 1, 1, 2, 3, 5, 8, 13, 21, 34, 55, 89, 144, etc. Again, each successive number is the sum of the two previous numbers. These numbers possess a number of interrelationships, such as the fact that any given number is approximately 61.8% of the next number. The ratio of alternating numbers are 38.2%. Also, it just so happens that 1.000 minus 0.618 equals 0.382. The midpoint of 61.8% and 38.2% is 50%. These are the three most common Fibonacci retracement levels. These mathematical numbers repeat themselves in all walks of life, and Fibonacci retracements attempt to measure the likely points that a currency pair will retrace or pull back to within a range. After a pair is trended up, draw your Fibonacci levels from the start of the uptrend to the finish of the uptrend. Your charting package will draw the retracement levels for you, automatically taking care of the math. Here's an example of the euro dollar. After a quick rise in April through June of 2009, the price retraced back to the 38.2% level. At that point, the pair bounced and resumed the uptrend. Other less common retracement levels exist. For example, the 23.6% level is said to be the minimum retracement level and represents the ratio of every third number in the Fibonacci sequence. Another less common retracement is the 78.6% level. It's the square root of 0.618 and is believed to be the final level of retracement before the trend is negated. How these numbers are derived is not the important thing to remember, but rather they represent hidden levels of support and resistance in a trend line. And again, the market scope charts will take care of the calculations for you. In the euro pound in April, we can see that after a brief down period, the price has retraced the maximum of 78.6%. Since you don't know if the price is going to stop at a given Fibonacci line, a way to look for confirmation is to wait for price to pierce the line twice. First, wait for the price to pierce the line, then bounce. Many times, the price will pierce the fib line again and bounce for a second time. It's the second piercing of the line where you would enter going short. Place a stop just above the swing high. Yet another set of hidden support and resistance levels are pivot points. Pivot points are typically used by floor traders who didn't have immediate access to computers. They needed a quick way to calculate potential pivot prices in the pits without requiring a lot of data. Pivot points are calculated by using the last trading session's high, low, and close, so floor traders could figure them by hand. Speculators have taken this concept and automated it, so most charting packages display them on your screen. Since Forex is a 24-hour market, most traders use the New York closing time of 5 p.m. Eastern as the previous day's close. Here are some types of pivot points. Standard or floor pivot points, Woody pivot points, Tom DeMark pivot points, and Camarilla pivot points. There are several types of pivot points, with each one having a slight variation from one to another. How you trade them are essentially the same, and I'll show you in an example as well. Since these varying types of pivot points are fairly similar to one another, from this point forward I'm going to solely discuss the standard or floor pivot points. Here's the calculation for the pivot points. You'll notice that there is a centrally located pivot with 2 support areas and 2 resistance areas. The pivot is calculated by essentially taking the previous day's high plus the low plus the close and dividing it by 3. The support and resistance areas are simple calculations involving this pivot price. Just like driving a car does not require you to understand exactly how the car was built, so too trading pivots does not require you to intimately understand their calculations. Most charting packages include at least one or more of these pivot levels as an option, and so we move on to a trading example. Pivots can be traded as areas of support and resistance, and therefore we look for a turn of direction, or pivot. To set up a trade using pivot levels, we'll need to add an indicator labeled pivot to our charts, and then press OK. Then a pop-up box will appear where you can customize the calculation of the pivot points. Most of the time, I'll leave this at the default levels, which will calculate the daily standard pivot levels. Press OK, and the pivot levels are added automatically to your chart. The results are 9 lines appearing on the chart. The middle line is my pivot point. The 4 lower lines are the pivot support lines labeled S1 to S4. The 4 upper lines are pivot resistance lines labeled R1 to R4. These pivot levels remain even as I change the time frame of my chart. For an example of how to trade off these pivots, let's look at the euro-dollar. We take a look at this pair as trading resumes at the beginning of the week in search of resistance levels to sell into. We can see that the gray line in between my S1 and R1 levels is my pivot point. Since the trend has been down on the daily chart of the euro-dollar, I'm looking for a sell short opportunity near this gray line, so long as I get confirmation of prices remaining below this level. To fine-tune an entry, I scale down to a 1-hour price chart. Several hours later, prices do punch above the gray pivot point, so I wait for a bearish candle formation or for my stochastics to turn down. You can use any indicator you would like. I'm just using stochastics in this example. A few hours later, prices do return below the gray pivot line and my stochastic crosses down, so I enter this trade short. I place a stop above the recent swing high and look to take profit at least twice the distance of my stop so as to maintain at least a 1-to-2 risk to reward ratio. This concludes our discussion on support and resistance. We hope you found this video helpful, and we encourage you to attend a live webinar on support and resistance with one of our course instructors. In the webinar, instructors will relate what you've learned here to current market and trading conditions, including some patterns and support and resistance areas that have recently formed and are in the process of forming. Instructors will also field live Q&A on the topic of support and resistance. Thanks for watching this video, and we'll see you in the live webinars.